Thank you for watching the webinar for an update on the wave of multifamily loan maturities presented by Gray Capital in the Gray Report. I'm just going to take a minute just to allow a couple other people to join the webinar. This webinar takes place after the release of our last report, updated report on upcoming loan maturities in the multifamily market. Joined today by Dr. Matt Bastnagel.
Hello.
Director of Communications and Marketing here at Gray Capital, producer of the Gray Report, and you've really been leading up the research efforts here at Gray Capital, specifically focusing on some of these upcoming loan maturities in the multifamily market. Matt, before we get started with the presentation, which the other big piece is doing a really deep dive on the current state of the multifamily market and how that affects the upcoming loan maturities that are really starting here in October, going through 2024, kind of fizzling out in 2025. Just before we start, any big, differences from the first report that you published in June compared to the last report that was published in end of September?
I've been talking about this, and we've been following this for so long. I've been looking for differences, and I kind of summarized it when I was talking with Dave yesterday, and I said there's nothing that goes against our fundamental thesis that we made in June. There's no reason to think that relief is on the way, that the wave is not going to hurt a lot of people. It hasn't. There's nothing nothing dramatic has happened yet, but it is just starting, and there really is nothing that contradicts what we said. So ultimately, what has changed is interest rates have gotten even tighter. The market has gotten even more painful for those that are facing loan maturities, and the challenges, I would say, arguably increase because we're not facing a potential, maybe there is a recession and interest rates will go down. The recession may happen, but higher for longer has become the dominant topic of discussion when we're talking about interest rates, and it is becoming increasingly apparent that we're in this for a much longer than people maybe even were discussing in June. So that's kind of what has changed, is the pressure has gotten more. And maybe that's kind of what we expected, is as long as interest rates are elevated, you don't even need to hike rates at this point. The pressure is continually being exerted on these borrowers. And so, and ultimately, what we've learned since then is that a lot is kind of going to be in the hands of banks and how they handle it. And I know there has been guidance from the federal government, not necessarily with any teeth, but they've been anticipating some kind of accommodations and workouts. I think that there has been a healthy amount of increased discussion about multifamily loan maturities in addition to the office market too. So I've been a little bit gratified, at least, that people are paying attention to this issue, and it's not just the collapse of the office market. People are realizing that elevated interest rates are hurting a lot of CRE borrowers, multifamily specifically.
Yeah, I think that may be one of the big, differences between the first report and from this most recent report and today, as we're discussing it, is that back in the summer, earlier in the year, there was still that hope that interest rates would come down, inflation would really be at a much lower point than it is today. We had a CPI report that came out today, more or less unchanged, but not declining. We haven't seen shelter come in. We know that metric is relatively delayed, but we were expecting that to start coming in by now. We were thinking we were going to see that in September. We're going to have to look out next month for October CPI number. But there's really no more time for rates to come down. In fact, rates have gone up while the Fed funds rate has remained at its 5.25 to 5.5. The 10-year Treasury has only increased. Now it's come down since last week, since the attack in Israel. It was at 4.9% at its peak, I think, at the end of last week for a couple minutes.
And people rushed in for like a safe bet?
Yeah, I believe so.
Okay.
And so the events over the weekend in Israel, there was a slight flight to safety.
Okay.
You bring that treasury down to, kind of the 4.5 level. But again, folks were hoping when it was sub 4 that it would be coming down closer to maybe 3.5 and 3.
Yeah.
So we're still 100 basis points, well above 100 basis points where folks were hoping things would start to become attractive in many of these assets that are financed, looking to refinance or need some sort of exit. That may be on the margins. That change in rate, is materially significant, and so if
Just
they were
just 0.2%.
Yeah. Absolutely. I mean, every couple basis points help, but when we're talking about 100 basis points difference of where they needed to be, or more than that, it may not be. They were hoping that if rates came down, if they could they could then refinance, maybe not have to bring as much cash to the table, going to have to raise capital from existing investors or utilize rescue capital in the form of preferred equity, mezzanine financing. Now they're going to need more capital potentially to inject into these deals to keep them alive or pursue loan modifications with their lender. But Matt, let's just kind of get into the presentation today. Just a quick reminder, obviously this is not investment advice. Quick disclaimer. Also, this is not an offer to invest in anything, certainly not from Gray Capital.
Invest wisely.
Invest wisely. My name is Spencer Gray. I'm the president, CEO, and founder of Gray Capital, as well as our sister companies, Gray Residential and Gray Construction and Design. And then I am joined by Dr. Matt Bastnagel, Director of Communications and Marketing at Gray Capital, also head of research and the producer of the Gray Report, and as well as the Gray Report newsletter, the best multifamily newsletter in the market. You can go to graycapitalllc.com/newsletter to sign up for that great periodical.
Yeah.
A lot of great work on the Gray Report, Matt. I mean, it's covered by and followed by a big swath of the industry. A lot of our viewership is mostly industry personnel rather than investors. A lot of investors also, but we know we get in touch. A lot of brokers and lenders reach out to us looking for information. As a central source. We're
tracking the the reports and all of the news every week on the multifamily industry, and it's really been helpful for me personally in catching kind of the pulse and tracking the loan maturities issues and all of the kind of ancillary conditions that play into it. And so I think that particularly this past week it's been top of mind.
Yeah.
And there are from student loan repayments to the potential recession, and all of the inside the kind of multifamily specific performance issues that we will see in the whole next year. And just the fundamental question is for borrowers facing loan maturities, is the next year going to be more painful? Is how much pain are they going to have until rates go down? And we just talked about higher for longer. It's going to be more than a year before rates get comfortable again. So how much pain and how much loss are they willing to accept over the next 18 months?
Yeah. It's a great question. If you'd like to view the latest research report, hop on over to graycapitalllc.com/report. You can download it right there. Nice and easy PDF. And then today, we're going to be going over the multifamily market, as we said, giving ourselves a little bit of context and what environment we're going to be seeing. If these loan maturities come due, as borrowers and lenders navigate through this, as well as brokers, the overall landscape, plays an important picture because the concept of chasing good after bad. It's a very different question if we're in a major recovery and we know that just a little bit of time, will heal all wounds.
Yeah.
But sometimes that time, the time required is longer than the time that we really have. And the terms are only so long. We've got a lot coming due. Certainly there can be some modifications. So also, of course, going into the details of these imminent loan maturities, really peaking, around right now in October is the beginning of that kind of front wave of maturities going through all of next year. Then also we want to take just a couple of minutes to talk about what we're doing at Gray Capital, how our strategy has changed over time, and what we're doing today in this relatively challenging environment, but an environment that I think will create incredible opportunities. And so trying to figure out when those opportunities are going to appear. I think we're getting closer, but we're not there yet.
Yeah.
So just starting with the market overview, Matt, kind of the headline piece that I wanted to focus on is the supply headwinds that we are seeing. I think we'd be in a different telling a different story if we were in a different supply environment, because demand isn't bad right now. Demand is relatively normal, and we're going to show that here in a second, but it is the amount of supply that is currently being delivered today and will be continued to deliver all throughout next year in this environment of considerable pressure. So just at the moment today, in the United States, we have over 1.1 million units under construction. 554,000 are expected to be delivered in 2023. Now, a couple of years ago, 2018, 2019, we were kind of in the 320,000 unit range being delivered per year. But again, over 500,000 just this year, and about 450,000 units expected in 2024. Then it really starts to trickle off. Now, if we were seeing, well above trend demand and growth, that would be one thing. But we're seeing, relatively normal demand, but abnormal amounts of supply. And that supply is highly concentrated in several markets. I would say most markets are seeing quite a bit of new supply, unprecedented new supply, but there are some markets in particular, primarily in the Sun Belt, that are just seeing a deluge that while there's great population growth, good employment growth, a lot of market fundamentals that make sense, these are markets that were overly concentrated from investors piling in, following a similar story. And just the simple fact is, that trade was overbought to an extent. And there will take some time for those excess units to be absorbed. I believe that they will over the long term, but there's going to be some headwind for individuals, again, that have financed assets that don't have much time. They don't have 5 years. They may have months to a year. Just looking at the second quarter of 2023, we did absorb around 105,000 units, which is really solid. But again, unfortunately, 145,000 units were delivered. So we had negative absorption. And again, we should see a pause in deliveries anticipated in 2025. Just looking at this chart from CoStar, you can see a big surge in construction starts, really beginning in 2021, surging in 22. A lot of this, Matt, was fueled by money essentially being free, Fed funds rate and SOFR at zero, only paying for the spread. The money, was abundant. The capital was flowing. And again, many investors had the same idea to build in popular markets such as Austin, Phoenix, Las Vegas, Atlanta, Charlotte, handful of others, which all have, strong demographic fundamentals, but there's way too many units, and some of these markets are now seeing significant headwinds.
Yeah, they chased the high rents. They came in after the high rents, and they enjoyed some, but now that they're built, the high rents are in the past. For a lot of these markets, especially the ones, those previously popular ones.
Yeah. Now, just looking at absorption again, you can see why it would seem attractive to build back in 21. Look at the absorption in the first and second quarter, Matt, of 2021. We absorbed over 250,000 units in a single quarter, and we were in that, kind of mid 175,000 units per quarter absorption rate, for several quarters. And you can see kind of normal absorption going back to 2013. We were, a quarter for a particular quarter. Anywhere we kind of between 25,000 units on a weak quarter, kind of pushing up maybe close to 100,000. Several quarters, we certainly got over 100,000, and we're back to that, kind of around 100,000 units being absorbed rate. A unit absorbed is essentially, someone that is renting a unit. The units come online. If we have more units that we have people renting, it leads to negative absorption. Now, CoStar's forecast, which again, take it with a hefty grain of salt, which we will, and looking at any kind of forecast, they're basically pegging that we're going to continue to see about 100,000 units being absorbed every quarter for the next several years, which again will absorb what's in the pipeline over time, but not in the near term.
You can tell it's a projection because of the very even lines of their projection.
Exactly. So now this is looking at deliveries and demolitions. You can see the demolitions do affect supply, but relatively immaterially. But it is something good to note. You see, again, the huge spike in deliveries happening right now at the end of 2023, and those deliveries remain high through 2024. You see that relative, Matt, to the last couple of years. It really started growing. It was low, post, financial crisis. I mean, it really bottomed out. But the story of, we just haven't built enough. We haven't built enough apartments. Well, we are catching up right now. And again, the challenge is we're not building these apartments just everywhere. These are national numbers, but they're not being, delivered evenly. They're being delivered, in markets where there was a very compelling story for continued growth, which, again, it not an incorrect thesis, but, you can oversupply. And too many people can invest in the same idea, just leading to a high price, which was reflected in extremely low cap rates. We've seen cap rates in the 2%, 3% range. Incredible. They were really hoping on continued high rent growth and not thinking that everyone else had the same idea that they had. Yeah,
it is very interesting to see such a precipitous fall in deliveries through 2024 and into 2025 and 26. Those quarters of 2025, you see, almost every quarter it drops by 20 or 40,000. That's a reduction in the amount of deliveries, almost to the level of the same amount of deliveries that we would have had in 2012. It's hard to balance.
That's a good point. Well, it's really falling off, but it's still basically going back to how many were delivered after 2012, which was kind of post Great Financial Crisis territory, and similar situation, lending,
kind of climbing
construction,
out of things.
Everything kind of ground to a halt. We're seeing a similar story that's unfolding, but at higher levels. I do think it creates an interesting environment. Again, 25, 26, 27, not as much supply being delivered. There's going to be some developers probably leave the market, and that slowdown in supply. I'm not saying we're going to have a repeat of kind of the 2010s or so, but there may be in that period, really kind of 2012, really starting in 2014, though, we saw some really strong rent growth, just because supply wasn't being delivered, and we had a really strong couple of years until things started kind of slowing down in 2016 or so, and started seeing much more normal rent growth. Of course, this is we're coming after legendary rent growth in 2021, 2022, which we'll look at here in a second. Just doing a quick regional overview of what is going on, because not every region, not every state, and of course not every market is created equal. The Midwest and Northeast are outperforming. Markets such as Indianapolis, Columbus, Ohio, Chicago, and New Jersey are the current performers in terms of rent growth. But we're seeing significant slowdowns in many Sunbelt markets, particularly Austin, Las Vegas, Salt Lake City, and Phoenix. That's just to name a few, but those are some of the once high flyers, in demand, very popular markets. Again, excellent demographics, but oversupply right now and seeing significant headwinds.
Yeah, and that's something that clearly hasn't changed since June. We saw that coming, and it's still apparent.
Yeah,
those high flyers, and this is something that we talk about on our weekly Gray Report show. Is the larger size of a market, they're kind of maybe able to navigate this increase in supply with more stability. But smaller markets like Salt Lake City or Boise, for instance, they're going to see some big swings because just when the construction trucks move into town and build those buildings, it's harder of an impact.
It is a classic story of kind of boom and bust.
Yeah.
And many of these markets have a reputation of seeing a boom and bust, specifically Las Vegas and Phoenix. Major culprits in the last financial crisis back in 2008.
Yeah.
I mean, again, those were markets that were booming. They were growing. They were growing back then as well.
Oh,
and
interesting.
It was a very similar story.
So
of just
in
boom
like
and bust.
Pre-great financial crisis, it was okay.
People
very interesting.
Oh yeah. This is an excerpt from the last report before this most recent loan maturities report. We released a report on rent growth and just fundamentals in the market. You can view that report at graycapitalllc.com/rent-report. Looking again just at some of these individual markets in terms of rent growth, rent to income ratio, and new supply. I'd recommend checking out the report after the loan maturities report. It really tells a tale of two cities of different regions. Again, Midwest really outperforming that in the Northeast as well. Both regions have characteristics of kind of linear growth, as opposed to kind of exponential and then just declines.
Yeah. Really
kind of just steady eddy markets that are truly shining right now, or at least stabilizing and kind of holding their own water.
Yeah.
And it is in those markets that we'll most likely see less distress or less concentrations of distress. In general, I see many of the Sunbelt markets, not all, but many, as being more prone to some risk taking, or my personal observations was quite a bit of aggressive risk taking, again buying at low cap rates, assuming very high rent growth for a prolonged period of time, max leverage, short terms, floating rate, and I think just a lot of operators maybe flying a little bit too close to the sun.
To the belt. Well, and that has been the dominant narrative for almost the past decade, is this migration to the south, to the Sun Belt, and the growth of these cities. And it's a very compelling narrative if you are banking on that long-term growth. But the fact is that some people were persuaded by a long-term narrative, and they started to make bad short-term decisions. So it's fine to buy into that narrative, but if your time frame is only 1 or 2 years, then you could get on the wrong side of an interest rate hike.
Exactly. And I mean, that is kind of classic market dynamics. It's really, I think there were a lot of individuals that were thinking that we were just going to continue to go up and to the right forever. And that's just not how things work. Things go up and down. You can continue to move up, but there are oscillations, and we are seeing those oscillations with the volatility really kind of bred from through the pandemic. But that type of movement is still being seen throughout financial markets, and multifamily is not spared from that. In some ways, even more so because of multifamily's perceived ability to have just be a less risky investment compared to others, and people were taking more risk with that less risky investment.
Like, well, we can afford because it's a little safer.
Exactly. Multifamily never fails. The default rates are under 1/3%, and not only is this coming to buyers and equity investors, but also investors and buyers of mortgage-backed securities, leveraging leverage purchases of those mortgage-backed securities, whether that is regional banks buying up MBS product. Think that makes essentially not a whole lot of risk. They can get a little bit more premium. They don't think they're taking more risk, but unfortunately, the values of a lot of those bonds now are significantly underwater, as are all bonds right now. If you're investing in what appears supposed to be the safest investment, the 10-year Treasury, you're down about 30% year over year right now, just from a capital gains perspective. Now, many of those folks can hold to maturity, but if there is a mark-to-market on their books, there's a lot of major low-risk institutions that are going to have a lot of losses on their books.
That is what is so – I'll never understand it about leverage, is how just a little more risk. If you are levered up so much, that little risk can bring a lot more pain.
It certainly can. And that was our perception, and we'll get to this in the Great Capital Strategy, but especially in 2020, early 2022, when the interest rates started rising, to us it became very apparent that there was a significant amount of risk. The risk environment has changed, and we're seeing it materialize now. Not only risk on the assets you already purchased, but the transaction risk of interest rates moving. You're putting a project under contract, maybe closing 90 days later. Well, that interest rate could move 50, 100 basis points in that period of time, and real estate. Typically, not always, but typically being a levered product, it certainly affects the value and those investment returns. And so the investment that you signed up for and underwrit, by the time you close on it, it really looks different from a return perspective. And so when you take risk into account, are you being paid appropriate premium, getting enough return back for the risk you're taking, and much of the market did not adjust those parameters. They assumed the risk to remain constant. They just saw returns declining even a little bit, but kind of continued on that same model and failed to adapt.
And maybe this is just how the economy works, but we had these boom times, and we are now in a time where it is more realistic, and supply is coming back, and there is risk, and it is a realistic risk. But I would not say that the multifamily market is in any way in like dire straits. It's just like bad decisions have consequences.
Yeah. If everyone had financed their properties like single family homes are financed with 30-year fixed mortgages, this wouldn't nearly be as much of a concern. We would have operational issues, whether that's supply related, whether that's expense inflation, which we'll get into in a minute also. It would be a tougher market, but it wouldn't be existential to the multifamily market and the broader economy. But one point, Matt, that you've made on the last rent report is on job growth and related to the economy in general, but it could be actually a lot worse. And where rents are is way better than it could be, again, relative to a lot of other factors. You can speak to that for a second?
Job growth or wage growth. The strength of the job market has, it has remained fairly healthy. Now, I know
record unemployment.
Every great jobs numbers makes people that are relying on interest rate reduction, makes them kind of a little more anxious. But the fact is we have beat back calls for recession since really the beginning of 2022. And its robustness is I think a sign that we're not going to have a huge economic crash. Now, I don't think a mild recession is out of the cards by any means. I think that what has changed in my own assessment of the job market and the greater economy since that rent report and since this chart is that it's becoming a little bit clearer that especially for like borrowers and for other people that are relying on interest rate reductions, they will need a crisis in order to make them realize that they might need to cut their losses.
So we really would need to see kind of a breakdown in the labor market to really start seeing those economic effects, and assuming that the labor market remains healthy, just not able to find enough, folks to kind of fill the essential roles that we need. It almost is acting at like a floor on the economy. And without anything breaking and chugging along, that's also keeping inflation up and interest rates up as well. What is that catalyst, which is a question we're going to ask later. And it's not an answer that we can provide, completely, but it does appear, for that, recession to take place, for interest rates to come down, and things really start moving. There does need to be some catalyst related to the labor market, we shall see.
The last jobs report was positive. It exceeded expectations, as many people say. But wage growth did not increase commensurate with job growth. So there's kind of that, and there are a number of you can go to the Conference Board leading indicators, and you can see that there's a lot of things that are pointing in the downward direction, and it may be that job growth is kind of cutting against the grain a little bit.
Yeah. So just a reminder, if you want to get that last report, greatcapitalllc.com/rent-report, give you more information on just where rent growth is going, and a little picture of the jobs market. A little preview. Okay, so again, back to the market. Supply is outpacing demand most markets. Demand is historically normal, yet rent growth year over year is negative in most markets. We mentioned some of the regions that are seeing positivity versus negative, but just getting to some more details and looking at some charts and graphs. Now, this is a chart, again, provided by CoStar of looking at absorptions, net deliveries, and vacancy. We see those net deliveries outpacing absorptions, really starting, really starting in 2022, but especially in 2023. But now also, kind of to note that vacancy number, relatively, it was staying in a band between kind of 5.5% and 6%, and we saw, incredible decline of vacancy going down all the way kind of that more 4.5% range. Well, we are back to pre-pandemic levels of vacancy, and again, the forecast for CoStar, which again, it's take it with a grain of salt. they're showing vacancy normalizing around 7%, just above 7%, kind of halfway through 2024, while it flatlines and eventually declines, corresponding with a slowdown in deliveries, again, taking place post-2025 and 2026. And so it just goes to show the incredible demand for housing during the pandemic, and then the snapback and the normalization that we're experiencing right now.
Yeah.
And how this relates to loan maturities, Matt, is we saw operators starting to make assumptions that we would remain in a high occupancy, high rent growth environment for an extended period of time, or at least for 2 or 3 years, which would get them the numbers that they needed to hit to either sell or refinance, also assuming interest rates would remain low and values would continue to rise or at least stay the same. All assumptions that are coming to be just not the case today. In fact, the opposite is occurring.
Well, and just to put an emphasis on that, I'm mentally building all this pro and con list.
Yeah.
Well, pro, you can maybe refinance, maybe rates will go down. There is so many factors that would make it difficult to go in the con list.
Yeah, if you look at if you're looking at a model and you keep all the assumptions the same, and then you just change interest rates, it's still a trouble situation.
Yeah.
But you might get out okay. But then as you continue to add the different variables that are different, that have gone the opposite way, and it's not just, we didn't get, we got 4% rent growth instead of the 10. It's you got -2.
Yeah.
So you need even more just to get back to baseline. You're below your baseline.
And building prices are still relatively elevated.
Yeah,
they're
cost
not
of construction.
Yeah.
I think they've normalized to a degree, but they're certainly not lower.
Yeah.
Much lower. They've remained elevated.
So, like, if you were counting on that renovation, and you're going to force appreciation through renovation, well, that may not be a great play at the moment.
Well, there's a lot of competition right now on the labor side. We know labor's tight. There's a lot of infrastructure projects that are directly competing with the same type of labor. Now we should see again this soften a little bit as more and more deliveries are completed, and there's a slowdown in general construction because construction financing is very difficult today. No longer can you get an 80% loan to cost construction loan. You're looking more at 60, 50% loan to cost, which makes it much more expensive from a capital perspective to execute those projects. Some of them don't make sense, and so a lot of projects are being put on hold.
Projects to build or to renovate?
To build.
What about renovation? Is that affecting that?
I think it is as well. Yeah, I think that with rents slowing down, I think people. Well, there's 2 ways to look at it. One, this costs are going up, and there's an uncertainty whether you can achieve those rents, especially if you've already raised rents, quite a bit in the past. The average consumer is seeing price pressures related to inflation, whether it's gas, food, utilities, etc. But I guess on the other side of that, argument would be since you're not getting organic rent growth, an operator may take the stance that you really want to try to force that appreciation. And if you are in a market where there is demand for a higher premium unit, a higher level of renovation, and it comes down to how much does it cost you to build it versus the rent premium. And so if you can still do something for $10,000 a unit and you can get a $200, $250 rent premium on that, well, that might make sense if you can prove that out. But again, there's the question if you can actually achieve that, if it's actually going to cost that much, which you can figure out in a relatively short period of time. But at the same time, you're spending money to do that. And a lot of operators are saying, I'd like to hold on to some cash right now, and I'd rather just fill up and become occupied. Again, occupancy is going down, vacancy is going down. So it doesn't necessarily lead to a natural conclusion of, we're losing occupancy, let's go and spend a lot of money. People are more shifting to lowering rents, adding concessions, getting filled up in heads and beds, much more in kind of survival mode rather than, let's move forward and spend a lot of money on units. When we might need that money for either a capital call or a refinance.
Well, and I'm thinking of all the complexities of a renovation project. That's risk. Risk may equal returns, but risk is risk, especially in an environment.
It depends on your experience. If you're an experienced operator, turn a unit if you've got a whole team, it doesn't have to be if you control your expenses, but for a new operator, certainly can be a big question. And this chart, again, provided by CoStar, but we've added a couple lines, just some trend lines, just to see the trend prior to the pandemic versus the kind of the rate of growth and the trend that was taking place, during the pandemic and those changes. And again, the point I wanted to make here is, looking at the two different lines and the slope of those lines. And if you were assuming that this rate of growth would continue that began at the end of 2020 and really went through the first quarter of 2022, which directly corresponds to interest rates rising, you're just using the wrong assumptions.
Yeah.
See how far off we are from where rents, would have been if we remain on this normal line. It doesn't look like we're going to have a mean reversion down to that, but we are seeing kind of resistance at the top end. We're still seeing kind of general sort of slow growth, but we're seeing much higher, I guess, much more volatile oscillations, seasonal oscillations still that we would see. You see these oscillations, again, these are all seasonal movements, going back from 2015, growth in the spring and the summer and declines in the fall and the winter. That's normal, but you're still gradually increasing, kind of at a 45-degree angle here. So we're still going to see that, but they're just much larger swings. We're having more swings to the downside and then moderate swings to the upside. And as we were talking, Matt, unlikely that we'll see a big fall off in rents because there is still demand. There is still a floor there. It's not like you can go out and buy a house because mortgage rates aren't cheap. But a lower growth environment over a period of time will bring us back to this original line. Yeah. But it may take a couple of years before we kind of are back in alignment with this normal rate of growth. Again, just looking at some numbers, market rent growth per unit and rent growth. Again, we were plus 10% 2021 through 2022, and it has really fallen off. Now, CoStar again is forecasting rent growth kind of creeping back up to 4% over time, but even that 4% isn't the 10% that many would have assumed. We are slowing down, but again, it's really more normalizing in terms of demand than falling off a cliff.
Yeah, if you look at how much mortgage prices and just the average payment for that a home buyer makes, how much that has increased relative to rents, there is arguably a cushion, and there's an argument to be made that rent growth has been a little more stable and a little less like hysterical almost in terms of like how just crazy high these home buyers are paying.
Yeah, which is normal. Yeah, it's normal. Before the pandemic, it wasn't like how let's really push rents. It was maybe like let's renovate a unit, let's fix things up. You look at the market. Are we well below market? Can we move rents over time? But operators weren't pushing for aggressive rent pushes. Yeah. And certainly early in the pandemic, no one wanted to push rents that much. And then it took a lot of folks about a year to realize, oh, wow, at the end of 2020, some operators did start moving rents because a lot of properties were 100% occupied. And if you had one unit that was vacant, like, well, let's just see what someone will take for it. Yeah. And then operators began discovering that people would sign significantly higher leases. Yeah. And until people said no, they just kept increasing and increasing. A little bit of FOMO the next year if you hadn't caught on to that news, and then it just kind of kept cycling out. Yeah. But the story has changed. It is back to a renter's market. Concessions in the above are all happening. Matt, I probably should have thrown this on the supply story, but what I wanted to show with this chart on overall and stabilized vacancy, first off is the narrowing of the spread, again, in 2021, between overall vacancy and stabilized vacancy. The difference between overall vacancy and stabilized vacancy is stabilized vacancy does not include properties in lease-up. Okay. When you deliver a new property, you're 0% occupied, right? And so that starts a bunch of zeros or very low numbers, really messes up your average. Okay. And so we'd like to let's just look at the properties that have been stabilized and running for a while. It really narrowed. New properties, really still in demand, leasing up incredibly quick. Now, what we've seen since the end of 2022 is these lines diverge, and it makes sense. With all the supply coming online, they are eager to lease up these units as quick as possible. Again, they're on the clock. they're on the clock. They're on relatively short-term construction loans with their current carrying costs, the interest rate specifically, interest expense, multiples of what they had anticipated.
Yeah.
And that will continue to bleed until they can either sell or refinance. And you typically can't refinance, and it's harder to sell until you are stabilized around 90% occupancy. And so it is a race to, again, get heads in beds and fill them up. And they're doing that by reducing their rents significantly. But still, there's a big gap, and we're seeing that overall vacancy really kind of pull away from stabilized vacancy. And it's also, really put a dent in stabilized vacancy at all. It's going back up. But, there's been more competition at the B-class apartments.
Yeah.
Some of the A-class, brand new construction,
Yeah.
they're coming out with relatively moderate rents. The B-class apartments had been raising their rents so much that all of a sudden that gap is very narrow.
Yeah.
It gives an opportunity for a B-class renter to upgrade for not much more from what they're paying right now. And there's a big difference between a 2023 delivered product and certainly a mid-'80s product,
even
early
if
'90s, even in early 2000s. It's a big
even
difference.
if it's like renovated, and you can still tell.
There's a difference. There's a difference,
And also, that this may be a little crass, but we are looking to, we want to buy apartments, and we want to find that the troubled buyer that's cutting, or the troubled seller that's cutting their losses and making what I believe to be a smart decision. You look for operators that have a loan maturity, but also maybe these construction loans are coming due, and that's another place for buyers to look. Is someone that wants to get out and doesn't want to continue to own, and they want to build, and so that may be another source of opportunity.
No, I think it's going to be a big source of opportunities, and it's something we'll get to at the close to the end of the presentation. As a part of Great Capital's current strategy is identifying developers coming out with projects right now that are in lease up, or they're getting ready to enter lease up. They're starting before they get their certificates of occupancy. Taking that off a developer's hand, obviously at a discount, works for the developer, but really works for us buying at an excellent basis. And then there's also a story. Obviously your overall kind of gross potential rent will be lower than maybe they want it to be, but you most likely will be able to get some rent growth over the next 5 or 10 years because you're so close to those B-class apartments. Again, they were in a race against time to try to fill it up. An apartment that should be leasing at let's call $2,000 a month, but they leased them up at $1,200 a month. Well, you've got an $800 spread there. You're not going to be able to achieve that overnight or even over a year or two, but you kind of know a target of where you can go. But you can also understand and imagine what that would do to the valuation if you were purchasing based on its income. Taking a typical income-based cap rate valuation metric, not just by a basis play, which is something else that we're going to get into a second, kind of basis versus risk and where that line is.
That's interesting.
Going back, vacancy rates are below pre-pandemic levels. CoStar estimates vacancy will reach 7% end of the year. And as we said, there's stronger demand right now in B and C class. We're stabilized. We just said that people are still going after A class, but in terms of rent growth, we're still seeing it in the C and B class. And another just quick fact, Matt, is demand for 3-bed units has really normalized. We saw, I'm going to go to this vacancy by bedroom. And this is just an interesting fact of when you're looking for what that unit mix should be. There's a big push going for 3 bedrooms, working from home, people wanting more space, using a third bedroom as an extra office. Makes a lot of sense. We're really seeing that reverse now, which was a little surprised to the degree, but you can see that I believe orange line, really has kind of corrected since the peak in 20, and it's really kind of continued to come down.
So at the peak of 3-bedroom popularity, it was the second least vacant style of apartment room behind the 2-bedroom, and now it is there's the most vacancies in 3-bedroom compared to 1, 2, or studios.
Yeah. Well, and the studios have also recovered. Pre-pandemic, studios were the darling. Highest rent per square foot, but then pandemic happened. No one wanted to live in a studio by themselves, so that vacancy increased all the way up to 8.5%. But it's since normalized. I think once the lockdowns ended, people kind of got back to normal life. It's come back down. It's gone up and down a little bit.
Yeah.
But it's something to continue to pay attention to, and it's really important. You don't want to be caught with the wrong unit mix in the wrong market.
Yeah, that's really interesting, and I don't know why. And maybe CoStar knows something about about a relative lack of studio apartments being built, but they predict a massive drop off in the vacancy and an increase perhaps in demand of studio apartments.
Yeah. Well, again, one bedrooms in studios were there were a lot being constructed, prior, to the pandemic, and then less during the pandemic as we were looking for more space. Talking about valuations, again, we've talked about kind of performance. Performance leads into valuations. Values have declined 10 to 20% since the 2022 peak. Sales volume is considerably low, but the hard part here, Matt, is there's limited price discovery. That means there's not many people buying and selling deals, and the few people that are selling, the few people are buying. At least it's really more of, we talked about this on the Gray Report yesterday, Matt, but it's these almost kind of forced buyers who have capital they need to place. They've already raised the money. They need to deploy it. Or you've sold an asset and you have a 1031 exchange. Your return perspective is a little bit different than someone who has a little bit more kind of discretion on where and when to place their capital. If it's a invest it or you lose it type situation, well, you might take a much lower return, rather than the zero in getting the fees to doing that deal.
Yeah.
And, have mentioned, but, a lot of, fees do incentivize operators to make certain decisions in doing deals regardless of the quality of the deal, but to get that fee in the short term is an incentive that misaligns interest between GPs and LPs.
And that's
to watch out for.
Yeah. We have talked about businesses where they just have to keep buying and selling apartments to keep the lights on. So maybe they'll take worse deals. And I also, just to kind of repeat and what you've noted here about limited price discovery, creating this fog of war and the low sales volumes, I think that the current cap rates are a little bit lower than they need to be, but they are good enough for about 30% of buyers. They're not good enough for all the buyers, but they're just good enough. So I don't think that the market's not in a healthy. You can't say that the cap rate is an accurate reflection of the confidence that market participants have in. Because they're not all there. They're not even participating. They're not confident. They're not participating.
That is a good point. And, the reality is, and we'll get to that here in a second, but if you look at recent transactions, you can point to a lot of still, low cap rates, higher than they were a couple of years ago. We're still seeing transactions kind of in that, mid 5% range. We've seen some in the 6% range. Yeah. To your point, still probably a little bit low, higher than it was though. But if there's only a handful of transactions, and the few that there were again 1031 buyers and buying at a 5.5% cap rate, I can sit here all day long, and I will here in a second say where I think cap rates should be and where they need to be. But the reality is, and the market speaks, and the market is the market, is that, the cap rates are still in that range, elevated, but not as high as, one may perceive. Yeah. We all have to be reminded, just real estate is so slow. It doesn't change overnight. We were reviewing a report, Matt, yesterday that came out from CBRE, looking at interest rates and cap rates. And one of the points that they really missed on the report is that they were basically assuming that interest rates and cap rates are going to move in lockstep, or 10-year treasuries, are traded on a daily basis. But multifamily properties aren't. And it's a much slower process, and it's a different type of environment, a private market versus a public market.
And what has happened in that CBRE, you can see, yes, the interest rate increased by a whole lot. Cap rates increased by a very little amount. And if, there is such a mismatch now because interest rate increases have outpaced cap rates quarter after quarter that there's a lot of catching up to do.
Yeah, there really is. So again, kind of looking back in the rear view mirror a little bit, and this is getting ready to look at, again, some of these maturities are coming due and kind of what predated it. Yeah. But again, just looking at the sales volumes, why there hasn't been price discovery. We're basically at levels like that we were in the first quarter of 2020, which nothing was getting done unless it was being done on accident. And we're below levels kind of post great financial crisis as well. But we do see, and again, this is where it's this transient moment in time at the fourth quarter of 2021, a significant amount of transactions and sales, right around 120 billion. Now, not all of those were financed with short-term bridge loans, but a lot of them were. Yep. We know this from the data. We know this anecdotally, just because it was easier to transact. If everyone was at the same purchase price, it was who can close the quickest. Mm-hmm. And this is where I think greed really seeped into part of the market, and people were saying, I want to squeeze out as much return as I can. Mm-hmm. And also, there was a thought, and this is probably the biggest driver. The rates were going to remain low.
Yeah, they're low right now.
And they were like, I'm going to refinance in 2 years, and I'm going to pull out all my cash, or I'm going to sell it, and I'm going to hit a home run. Mm-hmm. And so I'm okay with the risk. And that risk was much higher than they perceived. But I think all they could think about was, that promote and the return in 2 or 3 years. Yeah. And it had been working so long. People were in the middle of selling assets for insane valuations. And, why not have the party continue a couple more years? And there were willing investors to allocate capital to those deals. So, why not in their perception? Anything else on that chart, Matt?
No. But that is something, you talk about what's different between June and now. And even though the low sales volumes have continued, that has just been this dominant atmosphere. Is the low sales volumes in the apartment market have further kind of entrenched.
Yeah. Looking at cap rates according to CoStar, again, these cap rates aren't always accurate according to CoStar, because they were, much lower than this chart, kind of shows. Maybe this is a decent average. But generally, we're looking at really direction here when we're looking at this chart, Matt. In part, I also want to look back at history. We were in a 6 to 7 cap rate environment. Post great financial crisis, we were actually all the way up between a high 6s, 7s, and almost an 8 cap environment. And after that, when we had interest rates in the 5% range, especially you can go back before that, cap rates, again, going back 20 years now, but we were in the 7, 8, 9% cap rate environment. Mm-hmm. And we have to ask ourselves, if the 10-year Treasury is going to be at, just below 5% today, but as we're approaching 5%, what were cap rates in that same interest rate environment? Yeah. Now, I'm not saying that the supply and demand dynamics are exactly the same as they were 20 years ago, but generally, if we're talking about risk and alternative investments, and the risk-free rate, it's at least gives us a kind of a direction of where they could go, and then relative to where they were, and then the talk of we should still be in the 5 cap range. Yeah. That's hard to. I'm having a hard time squaring that. Yeah. The cap rates and 10-year Treasury rates should be about the same. Now, what has happened according to CoStar? Again, we see this big dip down when rates went to zero, as the feeding frenzy continued, and again, middle of 2021 kind of ended. Halfway through 2022, and we have now seen cap rates rise. CoStar is, again, forecasting with a grain of salt that we'll see cap rates hit their peak basically at the end for Q4 of 2024, a year from now. Now, they're not going to come down immediately, and they don't know. So there's obviously some sort of catalyst that is going to allow that sharp decline. They don't know what that is. Yeah. Whether that's a recession that takes place mid-2024, interest rates get brought down by the Federal Reserve, and eventually cap rates come down as we see people, still renting, and it's attractive, but people aren't buying houses. I can see that, but there's nothing showing us that cap rates should, necessarily normalize and stabilize with current interest rates in the immediate future. And again, wrapping all this back into loan maturities, Matt, it's not going to be in time for these loans that are coming due. Not only will the interest rates remain high, but the valuations will be down. It's a double whammy.
So would you rather, let's say, I'm going to ask you a quick, would you rather sell now, or would you rather sell in a year when prices are lower? It's a good
question. If you only had the option to sell now or sell in a year, you might want to. I think you should sell. You probably should sell now. You probably should have sold 6 months ago or a year ago. Now, if you are financed with a long-term loan, you should do neither. I mean, maybe you could have sold 6 months ago if you really wanted to and needed to, but why not wait 3-4 years? Because if you have time on your side, in all investing, but especially multifamily, you will get to the other side of it. What the return will be, that's kind of up to the operator and your basis and all of that. But the chance of losing capital, it gets much, much smaller.
Yeah.
But if your back's against the wall and you're under the clock and you're getting a call from the lender because your loan's coming due, it's a different story. You can't lose it.
Yeah.
All right, sales volume, market sale price per unit. Again, just seeing this volume really drop off, and I really don't put much credit on their price per unit chart, but as you see, it is declining quite a bit. They're showing that it peaked right around 260,000 per unit. Man, that's a lot. Now it's down to around kind of 230, 220. That's a national average. Doesn't really tell you a whole lot because there's no national average that you're buying. But generally, we're looking at direction here. Peaking at the top of Q4, really it peaked kind of in mid 2022. Interest rates started rising, Fed funds rate, and that decline per unit immediately started to fall. And again, so there's clearly a correlation between interest rates and price and cap rates. To say if interest rates remain higher and cap rates are still lagging, we should still see that expansion over over the next year.
Or the alternative is that multifamily has become less of a cash flow investment and more of a speculative investment. Because if you're really,
that's a good point.
If you're that far away and it's not making the money for you because of financing, then what are you relying on? Why are you investing?
It's an excellent point, man, and it's the truth. Is that it moved away from a focus on cash flow and more to a focus on overall capital appreciation, which it's always you're looking for some balance between the two. But it was more cash flow be damned. We can buy at extreme negatively levered interest rates because we're going to grow out of it.
Yeah.
It's the same idea. When you're buying a tech company, well, they can be losing money, but they're going to grow out of it, and someone else. It's the greater fool theory. There's going to be someone else that's going to just pay me a lot more money. And that was the case for, many years in multifamily. And multifamily doesn't go through frequent downturns. But, when it just seems the prices keep going up, I guess.
And the price of waiting for whether it is a tech waiting for the tech unicorn or waiting for the multifamily prices to kind of stabilize and start going up again. And I think this is probably why you saw a decline in tech investments too. Is this is making time more expensive as interest rates go up? You can't wait now.
Very, very well said, Matt. Time is more expensive. It's also doing a longer term strategy is harder too because you actually have to operate for a long period of time. You have to make decisions that are going to be the right decisions, not just for that year and not just that next quarter, but it's got to work out in 5 years. It's like you might have to spend a little bit more money, and you're responsible. It's like we're going to still be here, but if you have a mindset and a mentality of we're going to be here for a year, 2, 3 years, and then we're out, you're not going to be making the same types of decisions. I'm not saying they're making bad decisions, but you're not going to
the contractor.
But they're going. It's a shorter term mentality, but it seemed to be easier because you could go to investors and you're going to shorter the hold period, the higher internal rate of return, the higher the IRR looks like. And so if I go to investors and say, hey, we've got this great deal and it's going to be a 25 IRR or a 30 IRR, well, that's a lot more attractive to sell to people than saying we're going to have a 10-year hold. It's going to be a fixed interest rate. We're going to operate along period of time. There's going to be consistent cash flow, and eventually we're going to sell it. But it's only going to be a 15 or 16 IRR. People are saying, well, why would I do that? It's half the return. Well, in one scenario, you might lose all your money. In one, you won't. So that's the difference. So
risk is real. Risk is real.
On that 10-year hold period, you have an opportunity to do better also. A lot of our 10-year holds turned into 30% IRRs, Matt. But we had the flexibility. We could hold for another 5 years. We sold quite a few assets in 2021. First part of 2022, we took advantage of the low cap rates. We are also kind of buying in that same period also, but we had a strict set of criteria and ways that we would buy it to not put ourselves in this position. And happy we don't have any bridge loans right now at all. All right. So again, no, we can't be doing a market overview if we don't talk about expense inflation, because it's the other. Again, we're just talking about all the.
These are the cons list.
these are variables.
Very good point.
Even with some rent growth, which again, rent growth is negative in many markets. And Matt, we're approaching 3 p.m. We're probably going to go a little bit over at 3 p.m. because we want to get into all the details of the loan maturity report also. These are some of the big culprits. Payroll has gone up. I mean, it's hard to get the right people, and you have to really pay up to get the best people that you need. And it's all about the people. They make the difference. The right training, the right experience, and the right support all typically cost money.
Yep.
Insurance doubled, tripled, has quadrupled in some markets. The coastal markets are being hit the worst, but it's all across the country.
It's a crisis for a lot of people.
Yeah. Property taxes being reassessed. Well, your value went up, by 40%. Well, there's some reassessments coming down the line also. A little bit better in some more tax-friendly states in the Midwest like Indiana, but even us, we're seeing some reassessments. Yep. Utilities, they just keep going. It's incredible how expensive utilities have gotten. Contract services, everyone just sent at the beginning of this year.
That's what I was
referencing
contract,
earlier. Sending a new contract, and prices have gone up. It costs their people more. The materials are more. Not surprising. Contract services are up. And last, certainly not least, debt service. We're talking about interest payments. Yeah. Again, you took out that bridge loan. It was 300 basis points plus SOFR with a floor of 100 basis points. So you're paying 4% at the start. You're sounding good. And now the Fed funds rate in SOFR now is 5%. So you're paying kind of 8 and a quarter, 8.5% interest. A little bit different. Than you had anticipated. And even if you thought that interest rates may go up a little bit, very few people thought they were going to be going to this level so quickly and stay there for a long period of time. We'll all remember last year, back in 2022, people thought that interest rates may be declining at the end of last year, or maybe halfway through this year.
There is some motivated reasoning, and that's a lot of it is this last shred of hope that people are clinging on to.
And it's a good reminder. It's not just multifamily. I mean, it's multifamily specifically, is at a target. It's what we're focusing on. But there's a lot of other businesses that had short-term debt. The U.S. federal government not excluded as well. So it's a major macro problem. And there's a lot of direct analogies between what we're talking about right now and then throughout the economy.
And that's when I says I've kind of come around to this thought of, that recession just seems more inevitable now than then, and just to think about how much pressure it's placing on multifamily industry, how much it's reduced transactions, and how much that has got to be present in so many different, whether it's helping to pay the payroll of a company or helping to fund just commercial exchanges that are not happening now that would have happened otherwise. Yeah,
and we're seeing tight debt and high expenses, Matt. This chart, this chart specifically looks at origination debt service coverage ratio and origination loan to value, and then it's a quick figure from Yardi Matrix. 85% of U.S. multifamily properties record expense increases between 5 and basically 15% in the last year.
Yeah,
so again, you get a little bit of rent growth or maybe negative rent growth, but your expenses increase by 15%, and usually expenses aren't always including debt service because it's below the line. If we're talking about operating expenses, not even talking about debt service. And so you can see debt service coverage ratio, which is essentially your net operating income. Taking out your debt service, what do you have left over? You need to be able to pay all of your debt with a certain amount of cover. Typically looking like 125 or above. It was pretty high in, between 2018 and 2022, really strong DSCRs. But you say as things have gotten skinnier and skinnier, those DSCRs have gotten closer to 1. And just doing some research, looking on Morningstar and some other reporting services, there are a staggering number of properties, Matt, that have DSCRs below 1. Well below 1, who do not have the revenue to actually cover their interest payments.
Yeah.
But now this is the good side.
Yeah.
This is the good side. It's been a lot of negative, but it's also just been a lot of reality. The long-term apartment fundamentals remain strong. When we're looking at single-family homes, Matt, their prices have remained pretty elevated. They've remained pretty strong, and they've really taken away from multifamily. Now, does that mean that single-family homes should come down a little bit? Possibly, but it also means that there's not as much room for the valuations to fall so much. We expect some further declines, but over the long term, so we get through some of this technical difficulties, in looking at how many houses we need over time, there's still a ton of demand for multifamily, but that gap is relatively wide. The reality is, Matt, just fewer households can afford to own homes right now. The affordability has just plummeted. The minimum annual income, and this is a little bit outdated. Well, this is a couple months outdated. The minimum annual income that you need to afford a home has just increased substantially. And just look at this gap between mortgage payments and apartment rent. And this is at the end of 22. So it hasn't really changed too much.
And that apartment price and rent comparison, that was not even factoring interest rates. Once you factor interest rates in, it becomes insane how much. And again, this is an expression of housing demand and apartment rents. Housing demand is good for everything. It's kind of a rising tide that lifts all boats.
True.
And the fact that there is this gap between home buyers that are so high up there and rents that are relatively lower, hopefully means it. I think it does mean that we will be at least insulated if there is any crisis on the home buying side.
Yeah. So in reality, this spread most likely has widened as interest rates for single family homes has increased. The average mortgage rate kind of hovering in the mid 7s, close to 8%. And again, rents have, they're negative year over year. So this gap has widened further, making apartments that much more attractive. And in a higher for longer rate environment, again, apartments become much more attractive. Now, I do think this creates a great opportunity because there are going to be folks looking for single family homes. I think build to rent is going to be a great great market segment to be going after over the next 10 years. But in general, people are going to need a place to live, and apartments have always been that solution.
Yeah.
Matt, here's the elephant in the room, though.
Totally.
We got $2 trillion of multifamily mortgage debt outstanding. Now, this is not all coming due right away. Like this is just everything that's out there, right?
Yeah.
But it's a lot, $2 trillion of just debt. But a lot of it is coming due soon. We're at the front of this wave again. Just internally, we've been saying here at Great Capital that it's going to be quiet.
Yeah.
It's going to be really quiet until things start happening. And what that looks like when things start happening is yet to be seen. But October, as we are right in the middle of October, it's October 12th today, Matt. We're at the beginning of this wave front of maturities. That this is just CMBS, which is just a fraction of all of the overall loans that are out there, but just the CMBS that are coming due. We've got $8 billion coming over the next 2 months. Now, we did some analysis, most likely, total, based on percentage of CMBS relative to the rest of the market, there's probably going to be about $40 billion that are going to be coming due every single in October and November of this year.
Yeah.
I mean, it could be more. But then throughout 2024, we still see this, constant march of maturities and really kind of crescendoing again at the end of 2024 and into January of 2025. So we're not going to be out of the woods for a while.
Yeah.
Again, the question is, what will lenders do? What will they accommodate? Will kicking the can down the road even be a practice that is a worthwhile endeavor? Is it going to get you anywhere? Is chasing good after bad? For what? If rents were growing and the fundamentals were perfect, you can make a case that you just need a little bit more time.
Yep.
But if you can't chart that course of success and getting out, really prolonging the pain, but as we've said also before, Matt, there's really no incentive to kind of admit defeat early.
Yeah, there's no incentive, definitely, and we've seen dramatic examples of this from owners that were facing a huge interest rate crisis, and then listening to a interview with them, there's not a sweat, not a drop of sweat on their face. They are calm, cool, and collected. That's their job. Their job is to communicate, is to communicate that the ship isn't sinking while the ship is sinking. They have got to keep everyone happy at the moment, and there's no benefit for them to say that there's a crisis right now. So we won't hear about it until maybe even the end. This first wave till the end of the month. Is that when the bills from the banks come in, or is it all? Yeah. Okay.
Yeah. So this is a breakdown of the debt that's out there, who are the lenders? Now the agencies, we know, Matt, they're the big lenders out there. They're making up more than 50% of the market. Fannie Mae and Freddie Mac, the banks and thrifts, which are a lot of again regional banks. They're the ones that are issuing not exclusively bridge loans, but a lot of that is the bridge loans. The CMBS number that we said, that's at $65 billion right there. Okay, and then so that's indicative of the rate of expirations, essentially based on the cadence of transactions going back to 2021 in Q4. Okay. But this $600 billion number, it's a lot. It's that the $8 billion in October and September, that's a lot. Man, but 65 compared to 600 billion. That's a lot.
Yeah,
that is a lot. And so the on the upside, there is a lot of agency debt out there, mostly long term, floating in, fixed rate. And again, I do think that provides a floor to the market, a lot of stability. When we look at our portfolio, we have assets that are locked up in debt for as short as 7 years. That's the shortest, and as long as 35 years. Wow. Most of that is fixed. We've got a little bit of floating rate. But our property, Bills on Fur up in Granger, Indiana, we have a 2.7% interest rate that's locked in for, we've had that loan now for a couple of years. So we have 32 more years left on the term. Yeah. It's still 96% occupied. It's throwing off 10% cash on cash. There's not a whole lot for us to worry about. Yeah. There is no existential crisis, and we could go down. I mean, we've doubled our NOI over the first couple of years. But many owners and many properties are highly insulated, which is why it's a great investment vehicle. Is if you do it the right way, you can really insulate yourself from a lot of market volatility. But unfortunately, we got a lot of this debt that is not insulated. A lot of these assets that are not insulated from some of this volatility. Higher for longer, rates change the calculus for borrowers. Matt, again, this is really just going to show that rates are not coming to save the day for many borrowers, as was the hope. I don't know how many people told us, smart folks. Yeah. In the beginning of this year, they're like, well, we think that rates will be down close to the end of the year. We're hoping that we're going to refinance. If not, then what? They were like, well, we're not sure.
That's one.
Rates aren't lower.
And that's one thing that has also, changed since June is projections have gotten higher for longer. One of which is the FOMC themselves. They used to think that at the end of 2024, it was going to be 4.5, still elevated, and still probably would cause a lot of pain and hopefully maybe motivated some people to cut their losses. But then the other figure now is at 5.1% that they project at the end of 2024. So things are going up. And it is, I think, also the recent elevated job growth numbers support this projection of elevated interest rates through the end of 2024. And even if they started lowering them sometime close to now, it's going to take a long time for them to come down.
Yeah, not anytime soon.
Yeah.
I'm just looking at delinquency rates, outstanding delinquent loan balance by pay status. I mean, the good news, Matt, is, we don't see, a huge rush of delinquency yet, which was anticipated because there wasn't a whole lot that going on before October. It has been increasing on a month-by-month basis. Now, there was a huge spike early on in COVID, and we've never really gotten off of that. I think a lot of that is probably a lot of mom and pop operators. Be curious and why during a period of so much growth, so many people remain delinquent. But after it kind of declined, it has been creeping up, and the base of the default rate, to shock everyone, it's tripled, but it's tripled from basically a 0.2 to a 0.6. Yeah. So we're still at 100% in terms of default rates. But we would be at the leading edge if we saw many of those defaults. And again, the first step is not to default. It's not to foreclose. It's a whole process, and typically borrowers and lenders are trying to work things out. That's easier said than done in this environment. Going back to values, and we said this earlier, and I said assets should be trading in a 7 to 8% cap rate environment relative to history. We looked at that chart earlier, Matt, looking at cap rates, when Treasury rates were at a similar level. Again, we were in a 7 to 9% cap rate range. To achieve returns that are on the level with investor returns of a couple of years ago, this is the cap rate range that you need to be. so you would either accept, much lower returns in an environment that has more risk, which kind of goes against the grain of investing, or values need to reconcile with the rest of the market. Now, the only thing that could save this if interest rates come in. So really, kind of time is the biggest question right now. As long as time goes on, the more certainty of cap rates rising. If we do see a recession, a de-evolution of the labor market and declines, leading to a recession, interest rates come down, we could really stop this bleeding of cap rate expansion.
Yeah.
Hate to be the one no one wants to root for a recession, but it's not going to be good for anybody. You think the fundamentals of rent growth aren't great today, that normalizing rent growth, turns into further declines. Now, maybe see expense inflation slow down, but it's really not a great environment for anyone. The alternative is just kind of a slower slog, a very slow growth in a higher interest rate environment that gets us back to these higher cap rates. Now, as we mentioned earlier, again, if just the market is what the market is, I can say it should be 7-8% all day long, but it doesn't make it so. Recent transactions remain in the 5 to 6% cap rate range. So, I mean, that is what it is.
There's going to need to be pain.
There's going to need to be pain. There's going to be a catalyst, and we need the volume of deals coming on the market where deals outnumber buyers. Right now, buyers and sellers are still relatively evenly matched. But as that number flips, as we anticipate it will to some degree, that is when we would anticipate to see that continued expansion. And again, this is what it would translate into, additional price declines of 10 to 20%. Again, we've already seen kind of 10 to 20%. We could see an additional. Basically, we're saying we're halfway there. We're not all the way there yet. And I would anticipate it's going to be slow, and then it would be a quick slip down. Risk first basis. I was talking about this earlier, Matt. Basis, which is basically, when I think of basis, it's typically your price per unit. And I'm thinking about what it costs to build the unit relative to what I'm buying it for. So if I can buy something for less than it takes to build it, I have a good basis. If I buy it for what it costs to build, maybe it's an okay basis. If you're paying more than it costs to build, not great basis. Just very loose in general. The basis was going up. It was harder to justify some of these acquisitions, pushing well over $300,000 per unit, which is well in excess of what it costs to build. What it costs to build today, it's a good question. Probably closer to $200,000 a unit, like on just a garden style. Maybe kind of $220,000, $230,000 for something that's like more of like a high-rise market, a different market. Maybe maybe get close to $250,000, $300,000. I'm not as familiar on super urban core core primary market construction, like high-rise. More familiar with garden style. But we started seeing prices that are really kind of outside of price of replacement. But we're reverting back to a period where we are seeing good basis. We're seeing prices that are similar what it would cost to build something at the peak of construction costs in 2021. Which begs the question, though, if construction costs do come in, it could be a reality that people just paid too much to build something, and it only was justified at that brief period in time. So it's not the end-all, be-all. Just because that's someone paid to build something, that doesn't mean what it's worth. Because at the end of the day, what commercial real estate is worth is the income that it generates and throws off relative to the market sentiment. Talking about NOI divided by your cap rate gives you your value. Excuse me. So the basis is starting to become attractive. Again, the price of replacement is starting to seem better. However, when you still look at the numbers, the returns are significantly less than what one would expect. Yields are at par or below Treasury yields. Also known as risk free. More or less. Although one of the riskiest investments has been 10-year Treasuries if you're looking at it from a capital gains perspective. So the returns are unattractive in an environment where there's risk. You're not getting premium on the risk, but at the same time, there's a good basis. And so where is that balance, and where are your priorities? If you have a long-term vision, having a good basis play could make sense. But I also think it has to be relative to the return and the risk in the market as well. And so I think it's a push and pull. the basis play is what most brokers today will say is the attractive piece, why you should buy something. And it objectively is, especially if you look at a piece of real estate and be like, that's just going to be that location will be worth more.
Yeah.
You're really speculating.
Yeah. You're going to wait. You have to pay to wait.
You have to pay to wait.
Yeah.
Something that may or may not happen. Looking at your risk premium, the returns that it produces, and I'm not just talking about yield. I'm talking about total return, IRR, equity multiple. And part of that is the credit environment. Lower leverage, significant lower leverage, typically in kind of the 50 to 65 loan to value range, rather than kind of a 70 to 80% loan to value range that was more typical pre-COVID and in kind of early COVID periods. It's hard to get the same returns with lower leverage, but also expenses are up. There's kind of a mismatch of expenses of 2021, 2022 versus expenses of 2023, which are very different. Many brokers will sell you on the expenses of a year ago with maybe even the incomes of a year ago, or pro forma rents even higher. But it makes it, again, just a more dangerous environment for an operator not doing enough due diligence to understand what the prices of today are. Yeah. What is a realistic price for payroll? What is insurance? And if you're putting in your insurance assumption that you used a year ago, and then you get something under contract, you may be surprised when you actually get that quote.
Yeah.
So again, it's adding more uncertainty, less clarity to the market, which increases risk typically, and usually you'd like to be paid to take more risk. Otherwise, why take the risk when you can go into another investment vehicle and yield a little bit more attractive return? Maybe the same, but you're not taking much risk. And I'm going to get into when we talk about the rescue capital, I'm going to talk about some other options as well that people are looking at and seeing as more attractive than just investing in common equity. How long can we extend and pretend? Matt, what is extending and pretending? What is the concept?
Pay and wait. It is extending the period of your loan and pretending that the interest rates are going to go down and that you can survive it. That is the long and short of it. And for some it's longer than others that they have to wait, and others.
A lot of it, and it's also pretending that the values haven't changed either.
Yeah,
right? And that's kind of both the borrower and the lender are incentivized to do that. The lender doesn't want to admit that the value of their loan has gone down. The owner of the property doesn't want to admit that the value of their asset has gone down. And they can kind of bury their hand in the sand for a little while because unless there's really a capital transaction. Who's market it? Who's market? There's no mark to market. Now you say you could get an assessment, you get a BOV, you get a valuation, but there's a lot of hesitancy and a lot of incentive to do that unless you're forced to put pen to paper and make something happen, which is why people just want to push things down, kick the can down the road as long as possible. There are discussions happening. Again, we've talked about the inability to admit defeat. There's also the fact there's a lot of well-capitalized borrowers out there. There's a lot of borrowers that have sold properties 21, 22, have millions of dollars in their pockets, and they can float some of these properties along, just kind of feeding them cash. That can only go on for so long, whether they have the ability to, but do they have the fortitude to continue to do it? And again, it's the idea of chasing good after bad. Money can come in other forms, though, in terms of rescue capital. Really 4 different types of rescue capital that we're seeing out there. First, preferred equity, which has become a very attractive investment vehicle as of recent. And it's one of the forms of rescue capital that's out there. And preferred equity is essentially you're sitting in a position right behind the bank, or typically mezzanine, if there's mezzanine debt on it also. You're the first to be paid before common equity. Typically, there's like a current preferred return that you pay, and then there's the amount of return that's accrued to the end. But your upside is capped. So it's called 14, 15%. Any return over that level, the rest goes to common equity. It's typically only make a certain percentage of the overall capital stack. Also, it's not a big portion, maybe 10%, 20%. It allows to go for a little bit of higher loan to value for some people. If you consider it debt, less equity that you would need. It's another way to financially engineer. That's how you use preferred equity when you're acquiring something. But in this case, trying to refinance, and a lender comes to you and they say, hey, we'll refinance your loan, but you're going to have to bring about $5 million. I know you have $5 million in equity in the deal. You're going to need to bring another $5 million to the table. That's hard to do. maybe that sponsor and operator can't raise that $5 million. Maybe they don't want to raise it.
Yeah.
They go to preferred equity investor, and I don't know if they can get the full $5 million. So maybe they're still going to have to find $2.5 million somewhere, but they can find another $2.5 million in the form of preferred equity. Now they're going to be the first ones to be paid after the bank. So at the end of the day, another year or two later, however long it may be, if the valuation still stays low, there may only be enough money to pay the bank back in the preferred equity investors and nothing for the common equity.
Yeah.
So we're talking about return destruction, essentially. Anytime you're really engaging in any of this rescue capital, you are destroying your returns.
Yeah, that's what I was thinking.
you may live to fight another day.
Yeah.
You may not have to hand the keys back to your bank, but your returns are not great.
Yeah.
They're if anything, you may get your money back. And that's the choice that many borrowers are faced with today. You're looking at multiple unideal outcomes. What's the least worst choice that we can make?
It's almost like people. It's almost like let me just make it through this year. I don't even care if I survive afterwards, because you could load up all this, and then who would want to invest with you after this?
It depends. Unfortunately, Matt, there's probably going to be some very large groups that have deals that go to zero. I mean, Blackstone has already handed keys back to the bank. But if you're so big, one deal out of 100 or a couple hundred doesn't matter that much.
Yeah.
It should. It matter a whole lot to us.
Yeah.
But to some groups, they can get away with a bad deal.
And
that can be the danger. You can get to a certain size where there's, I think, a false sense of security from investors of like, they're a big group, they've been doing this for years, they're incredible, they've got a great track record.
Yeah.
It's like, but now they can afford to lose a couple.
Yeah.
I don't want to be in that group where, as opposed to, and I'm not talking about great capital, but a group size or at a time of great capital where we need every deal to be
well, and
successful.
I would be worried if I was an investor and I had a direct investment in a building that was doing poorly, and I saw all these conditions, but then the GP is saying, oh yeah, we need to get a little bit more money, and we're gonna do a preferred equity play, and this is gonna be fine. But what power would an investor have?
I was talking to an investor over the weekend, and he said, first capital call, okay, I hitch my cart to your wagon or whatever, okay, I'll do the first one.
Yeah.
But I'm marking it as zero. In my book, that investment is going to a zero.
Okay.
And some investors won't even make the first capital call. They're just saying, okay, that investment's a zero. It's going to go to zero. I'm never going to see that money again. Why would I double up on it?
Yeah.
That doesn't make any sense.
Yeah.
Why am I doubling down, when the dealer's showing it, when it's showing a face card?
Yeah, yeah.
No, there's no reason.
Okay.
That's when the folks when you surrender. In blackjack. But there's other cases, and I participated not a great capital call, a deal that I was in just as an LP that had a capital call. It was in the form of a note. But there was a clear path.
Yeah.
But it wasn't on a bridge loan. It was on a long-term HUD, debt of 3.25%, but it needed an injection of capital because it needed some upgrades to be competitive. The business plan made sense. Some investors didn't meet it, but I believed it made sense. There have been other cases where it's like, no, this is a zero. And if it's not, my return, I'm diluted if you don't meet a capital call, but you're not going to zero. And if it works out, great, but you don't want to double down. And so there's a lot of discussion of when is it appropriate to chase good after bad, and it may not be. So Matt, just getting back to this question, what will be the catalyst to start moving the market? We talked about the labor market declining. That's just not there today. We'd have to see layoffs. We'd have to see really a change in the economy. Black swans. Talk about a black swan over this last weekend. Yeah. The whole situation is Israel and Palestine. We're still seeing the effects of that. Short-term treasury rates have gone down. The stock market is still going up. I don't think anybody knows how that goes. If it entered into a full-scale war in the Middle East, inflation I don't think is going down anytime soon, as oil most likely will go up. Certainly uncertainty. maybe see a decline in the stock market. We just don't know. It could, everything could work itself out. We all hope that it will. But most likely, there's going to be some sort of catalyst over the next year to change course. Otherwise, we're most likely seeing this higher for longer environment and just kind of muddy growth.
Yeah.
I want to talk about great capital strategy, Matt.
Yeah.
And then we're going to take a couple questions, and then we will bring this webinar to a close. And as well as get into your questions, there are already a handful of good questions. Early in 2022, Great Capital, we made a significant shift in our strategy on how we were acquiring and how we would finance assets. Matt, you probably remember we had a L team meeting in the conference room when I basically said, look, there's a direction that this economy is going, this market.
Yeah. Saw
things pretty clearly, mostly based on the fact that raising interest rates where they need to be taken to would most likely, based on history, break something in the economy and create a recession. There's never been a rate hiking cycle that has not led to a recession.
Yeah.
And we're getting to that period of time where you may expect it. Yield curve has been inverted. It started to revert a little bit, which again is kind of those telltale signs that maybe we're looking at a recession in the very near future. Again, what that catalyst is unknown, but just looking at the technicals, we should be getting close. Made a couple changes. We were always buying positively levered, but as interest rates rose, it became very easily to all of a sudden most deals were technically using negative leverage. Your cap rate is lower than your interest rate. Really, again, it not necessarily accretive to. It's really not accretive to the investment. So all our deals have to be positively levered. Our cap rate needs to be higher than our interest rate. We want to avoid catching a falling knife. And so again, we want to, assuming that cap rates would continue to expand, we needed to be ahead of the curve. For example, in the end of 2022, Matt, we bought a 2012 built A- class asset. It's really A, but you could call it just because of the vintage A- class asset for a 6.5% cap rate. It was a REIT in distress. They need to get rid of the asset. We said that checks our box. It's positively levered. We're buying at a huge discount to the rest of the market. We went forward on that transaction. The next property we acquired was at a lower cap rate, kind of in that low fives, but we assumed an interest rate of 3.5%. So a lot of positive leverage there, creating some yield. We haven't been able to find too many opportunities since. In the time we haven't been acquiring as many assets, actually there's a big silver lining. We did a big focus to shift on internal systems and expense control as inflation rose. With our in-house property management team, we were really able to tighten the screws out of things, admittedly started getting a little crazy at the beginning of this year. As expenses were rising, we had to relook at all our contracts. We had to redo all of our budgets, implementing new systems. How can we leverage technology? We're still in the middle of a lot of this. There have been times where I'm like, all I want is a deal right now. But I'm saying if this gives us a great opportunity to improve the assets that we currently manage and build an incredible platform for future acquisitions over time. When right now we'd be buying at prices we know would be lower in several months. So while we're leaving no stone unturned, very few attractive acquisition opportunities. So we've still expanded our deal funnel, more direct outreach to direct sellers, brokers, as well as lenders looking for opportunity. We've also are exploring low leverage and all cash transactions. All cash sounds crazy. I was saying cash is trash a couple of years ago, Matt, when rates were zero. It kind of was. But we're in a different world. Cash is king again. The golden rule, the one of the gold makes the rules. And you can typically have your terms, you can have your price. Well, if I can give you your terms of a quick close, 30 days, I'm going to need my price, which is again, 6, 7, 8% cap rate. We're not seeing that yet, but we're bringing new tools into the toolbox. It means raising a lot more equity. I'm talking tens of millions of dollars of all cash, but it allows us to move very quickly.
It takes that interest rate out of the equation too. To a certain degree.
No. Well, it leaves its maximum optionality. It's efficient. But what's the problem with deals these days? It's not, again, the basis is fine. It's the interest rate. It's the debt service payment. So the question was, how do we, if there's one variable that's messing up the deal, can we just remove the variable?
I'd like to do that, please.
let's just take that out of the equation. It's a great asset and a great location. Let's just take the piece out that doesn't work.
Yeah.
It's simple as that. Now, again, if values continue to decline, you still need to buy right. Doesn't mean you can just buy whatever. But man, your risk goes way down.
Yeah.
And then, because the reality is the unlevered return, not using leverage, it's still lower than your levered return because you have to raise all that equity, but it's not much lower.
Well, and you are, instead of paying to wait, you're waiting, and I'm assuming that you're,
waiting to get paid.
Yeah, waiting, getting paid. That's right.
Because if rates do decline, when rates decline, not next year, not the year after, but let's say 4 years, 5 years from now, you can refinance, and even if rates stay the same, you can still refinance because you've increased NOI. You can return the bulk, if not all, of that capital, maybe even plus 100%.
Yeah,
return all that capital plus some, maintain ownership. But as a base case, I think that's the upside. The base case is you just hold it all cash, 10 years. You get good yield. I'm talking average 8%, cash on cash return. Love for it to be closer to 10. But just today, what we're seeing, kind of in that 6, 7 cap rate environment, you're getting cash on cash, kind of 7% ish or so. So pretty solid, more than a treasury yield. But your IRRs are still, pretty good. They're low teens, 12, 13, 14. You get some cap rate compression. You can get it up maybe up to 15 for a short hold period of 5 years. But if you refinance, you can get the best of both worlds. Yeah. And you don't have to. And so it's a lot of optionality, and it's a strategy that, again, we're having conversations with our large investors. It's a different way to do it. It's something I never thought that I would even consider doing. If someone...
And not 2 years ago. Yeah.
Right. I think, some investor was talking, maybe it was my dad, saying, why don't we buy all cash? And I figured to roll my eyes. I'm like, why would we do that? And I'll why buy one deal all cash when we go buy 10 deals and lever them up? Yeah. It makes a lot of sense. But one, there's not 10 deals to buy right now. And two, interest rates are very unfavorable. Yeah. We're targeting new development. Again, cash flows fast, efficient transactions. As we said, ability to refinance and cash out when rates decline. But we're looking at the newest, the best product in the best locations. That's what we want to target. And we think it's out there. And specifically stuff that is being developed right now.
Yeah. Well, then like you described.
On a construction loan. Another thing that we're doing, this is the big change. This is something that I don't think anyone's ever heard us talk about. Maybe if you're listening to the Great Report, I've probably mentioned it before. But we're going after some ground up development. Now, this isn't a next year thing or year after. You're not going to get an offering from us anytime soon. I guess get in touch with us if you want to talk to us about it. But we are strategically acquiring land in paths of development. Some markets that we know intimately well. Some areas that we have long history in. Know all the players. Know where the development is. Thousands upon thousands of jobs. Tens of billions of dollars of construction projects. Really exciting opportunities. We won't be breaking ground, though, until late 2024. We're looking at build-to-rent, multifamily, and some townhome developments. Again, because there's going to be that window at the end of 2025 when deliveries really fall off a cliff. We would be hoping to start to deliver around that low point. Yeah. That is the idea. And the challenge with this, though, is that, again, construction financing is tough. Yeah. We're not getting those 80% loan-to-cost loans. So it's going to have to be relatively low leveraged, which is a challenge. It's more cash. It's less risk. We see it as a great opportunity to continue to grow and do some great things in some great markets.
Yeah, that's really exciting.
Yeah. The other thing is we're going to continue to sharpen the axe. Yeah. We're trying to get better, continue to practice, improve our internal systems, whether that's on the acquisition side, operations side, property management, asset management, or marketing, everything. Yeah. There's so much room to get better. If I'm not raising capital for a deal, and I'm always raising capital for, our next deal, but it gives me more bandwidth to make our deals even better and really focus. I'm not out there. I'm not like, we don't have any deals. I'm going to go out on the beach and just not do anything. Yeah. We did a podcast yesterday with the Cushman team. What I'm so excited about right now is all of these advancements in technology and leveraging technology to operate more efficiently, bring multifamily into the 21st century, just a little bit. We don't have all the solutions right now, but just being laser focused as an objective of we know we can do better. We know the whole industry can do better. let's see what the best are doing and match pace and
to know enough about the technology to know, okay, I don't want to buy that $10,000 service. Maybe I spend $500 and it does the same thing. To make those, that's almost like equally exciting for me. Is like, if you have a little bit of know-how, the technology does not become magic. It's just a tool that you can use, but it just requires some understanding.
Yeah. But it's like, how can we do more? Provide a better experience to renters with less people, and just having our people do the things they're best at. Yeah, that essential human interaction, Matt, that is key most of the time, not always, to closing a deal or what people need, whether it's customer service, but so much of the follow up, so much of just the information gathering that people are focusing their time on now can just be automated. AI has made a lot of progress. Still not the way, it's not there yet to be completely implemented. But knowing where we want to go is helping us kind of chart a course of what it should look like, when that technology is available to be rolled out. We use ChatGPT and all that stuff, but to be able to plug and play for new leasing consultant. You can't just give them ChatGPT and let them go run wild.
And that's what I think and that's what I understand you meant by sharpen the axe is keep looking into these technologies. Keep looking at on the acquisition side. Keep getting involved in deals and keep be connected with your operations. Don't just kind of detach and say that you're going to wait it out, because there's a lot of work that can be done even if you're not raking in deals hand over fist.
Yeah, good point, Matt. All right, just to get a little bit of Q&A before we wrap up today. A question from Hunter Lean. Do you feel many of these maturities are geographically concentrated? The coast and larger scale growth markets come to mind rather than the less sexy markets. I'd agree 100%. It's a really good point that is well taken. The reality is that markets like, to our dismay, Matt, markets like Indianapolis and in the Midwest are probably going to do pretty well. There's not going to be as much stress. There's going to be some, but it's going to be pocketed. It's going to be a deal over here, a deal over there. Like we said, in not necessarily, certainly some of the areas of the coast, markets like San Francisco especially, but it's also in markets like Phoenix, Austin, Las Vegas, the ones that we mentioned, where there was a lot of aggressive buying. Bridge loans were the way at the time, and incredibly aggressive rent growth pro formas. That's where I see the most distress occurring and being concentrated in the Sun Belt.
For as much as we saw those, we were looking at national numbers where you saw the rents decline and all that. The declines that you could catch yourself on the bad side of a rent decline on some of these Sunbelt markets, and that's a real crash. And it is interesting, specifically some of the big name failures and implosions of these syndicators because of interest rate, et cetera, they were in the Sun Belt. And that was where a lot of their portfolio was. And because and this is pure speculation, I bet it was easy to call up a bunch of investors and say, come, let's invest in Austin, let's invest in Phoenix, let's invest in the Sun Belt.
Well, it's all people wanted to talk about. Again, just going to NMHC, which is the National Multifamily Housing Council's annual meeting that takes place. Most of the industry shows up. What people want to talk about? There's two types of markets people wanted to talk about. They were Sunbelt markets, and then they were gateway coastal markets. If it wasn't New York, San Francisco, or Dallas, Atlanta, Phoenix, didn't have time for it. They wouldn't even. There wasn't even a slide for the Midwest. Or if there was the slide, they skipped over the slide. A little bit. No, I did. I would look around and I'd be like, no one sees it. Okay, that's fine. I'll just keep going. But again, it's like, we're probably not going to see the deep opportunities because of that. I think there's going to be some, and we know, and that's why specifically, we're going to be targeting less older properties or B class that people bought on a bridge loan or renovating. We're not looking to buy like failed value add deals.
Okay. I
don't want to open up the can of worms, but I'd rather buy brand new construction, best of the best at a significant discount at a similar cap rate, maybe as the value add stuff in the best locations where someone was developing and that debt service has just, and the carrying cost have just risen to a point where they just need to get out, they need to stop the bleeding.
Yeah.
We're already seeing some of that. It's too early to say, but that, that's our objective. We look all over the country. We focus on the Midwest. Could we go to some Sunbelt markets? No big plans to, just because, again, we like stick to our knitting and not let's just go chase stuff over there. And there's a lot of the long-term fundamentals of Indy are so strong.
Yeah, true.
In the Midwest. So we're going to kind of stick to what we know and what we've been really successful at. A little bit of a different way. Again, we see some opportunities to build from the ground up. See some opportunities to buy some stuff that was just built from the ground up at a deep discount. We're going to stay agile. And also, we're going to, as the Federal Reserve say, we're going to be, data dependent. We're going to see the data as it comes in. If it changes, it changes. We're going to move. We're not, we're not making a big, recession call, Matt.
Yeah.
We're just, we're kind of reporting the data that we have seen and why. But we get a lot of questions from investors of when's your next deal?
Yeah.
Every day almost. It's certainly every week. It's I'm ready for your next deal. I've got X amount, $100,000. I'm ready for your next deal.
Yeah. I've
got tens of millions of dollars for your next deal. We have more committed capital than we've ever had. That's ready to go.
Well, and in the market period, there's a bunch more dry powder for multifamily.
Yeah. But I'm not going to come out with our next deal and in being a mediocre marginal deal. Just not going to do it. So let's see if we have any other questions. I don't think we do. Thanks everybody for watching. Anthony, appreciate the comment and the shout out. Griffin, also appreciate the shout out. Make sure you subscribe to the Great Capital YouTube channel. You'll get updates like YouTube lives like this, as well as the weekly Great Report podcast and YouTube series where we cover this stuff every single week. Not exactly like this. We're mostly going over other people's research reports. Today we're going over Dr. Bastnagel's research report, just in an in-depth way. Matt, thanks for being here. Thanks for putting that report together.
This is great.
Again, it's been highly cited, across the industry and in the media, and it was highly anticipated, this update to the report. So thanks again for all your work.
No problem. We'll still keep thinking about it too.
Exactly.
We're not gonna stop.
Yeah. Well, it maybe tell us just as we close. Next report. Any ideas?
I don't have any specific ideas yet. I do. I am thinking a lot about apartment sales. And I know that kind of follows from interest rates, but that's the weirdest thing, the most divergent and different thing that we saw in 2023 than anything else, even more than supply, arguably, is the fact that it was just such stagnation. Yeah. And and it maybe it's a series, it's an investigative reporting where I interview a bunch of brokerages.
Oh, I like that. I also just again, we talked a lot about it today, but the supply, deluge of supply.
Yeah.
I mean that's the what's affecting the market just operationally. It's supply. It's supply. Because demand relatively
that would be another
normal.
good report is to figure out where supply is coming in which markets and stuff. And I think that's another thing that I'll look into for sure.
Because you can build too much. There is such thing as too much of a good thing.
Yeah, and supply is so local, where
hyper local.
So a lot of this, a lot of the supply or the supply bump could be in certain markets, and it's always pays to figure out which ones.
Absolutely. All right. Thanks for everyone watching this YouTube live stream of webinar on imminent loan maturities. Special edition of the Great Report coming live from the Great Capital YouTube channel. Again, reporting from the Great Capital Studios in Indianapolis, Indiana. Check our website, greatcapitalllc.com. Again, subscribe. Give us a comment below this video or in any of the videos. Make sure you like this and share it, repost it. Give the people what they want. We'll see you next time.